Stifel chief equity strategist, joins us now. Barry, good morning. So, I guess we're about 20% through the first half. What's been, I guess, the kind of animating force of what we've seen so far, and how do you think that's going to evolve from here?
Well, Mike, your opening monologue was spot on. I mean, for a couple months here, we've been in a trading range on the broader S&P 500 index. The no landing theme seems to be gaining traction. Inflation is proving very sticky. The Fed is sounding like they may not cut again, and the yield curve is flat. It probably would be positive, but for the repressed term premium. So the market's digesting, and I think we're in agreement that if there's going to be a rotation, it's like rearranging the deck chairs. The back half could have more cyclical growth, or it could have a slowdown in real wages and real buying power. We just don't really know yet for sure, so we've barbelled the approach to the year.
And what does that mean, I suppose, in terms of portfolio approach right now? If you assume, I guess, that we're still going to be feeding off of some of the positive forces for a while, or are we set up for an immediate growth scare? Do you look for what's already been working, or are you looking for the neglected areas of the market?
Well, you've got a 10-year yield, for example, that's 4.5%. That's pretty good competition for risky assets. And there's not a lot of reason from the sounds the Fed's making on rates to believe that that yield is going to drop. So if you have things like the leading indicators, like take the Purchasing Manager Index for manufacturing, currently around 50, if that makes its way up into the low 50s, then the no landing theme gains traction, but some of the high PE multiple growth stocks would pull back. Not so much because they're poor investments, although I would argue they're spending all of their cash flow on capital spending, so they really don't have a lot of free cash flow to value. But that said, the broadening of the market would cause the cap-weighted S&P, which is really top-heavy with tech, to pull back. The back half economic concerns are a whole different matter. That has to do with real wages, cyclical slowing in productivity, sticky inflation, and a Fed that's probably going to be somewhat alarmed as we exit the year.
So that would be the sort of inflation part of it, right? Where you basically don't get a lot of relief on the inflation measure. You did have, Fed, Vice Chair Christopher Waller talking about, looking through tariff effects of things like that. How is the expected policy influence going to bear on what we end up seeing in the interplay of growth and inflation?
Well, tariffs, a little bit like hikes in the value-added tax that's happened in Japan and in Europe over the years. They can be seen as a temporary one-off step up in inflation. But more important to us is this matter of unit labor costs. We actually think productivity on a year-over-year basis rather than quarterly annualized has peaked, obviously, and it's going to dissipate as the year goes on. This is very common after slowdowns, and one would argue that 22 to 23 was a slowdown in everything but employment. So as the productivity dissipates, unit labor cost, this is the cost per unit of output, stays relatively strong, and that means the core PCE inflation will stay closer to 2.75. The Fed wants it to be 2.5 for the year. And if they don't get what they want, then no rate hikes or no rate cuts are coming, and possibly hikes by 2026 if the economy hangs on.
Yeah, obviously a lot of things moving on all those different axes. Barry, thanks a lot for laying it out for us. Appreciate the time this morning.
Sure.